Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition of Macros with Mythili, we are going to discuss, well, what else? The Reserve Bank of India's latest monetary policy statement announced last Thursday, which had the markets puzzled, surprised, shocked. And joining me in the discussion are two experts, Mr. R Gandhi, former Deputy Governor, Reserve Bank of India, and Rupa Nitsure, Chief Economist, L&T Finance Holdings and formerly Chief Economist, Bank of Baroda. Welcome to the show, Mr. Gandhi, Rupa. Let me start by asking both of you the rather obvious question. Were you as surprised as almost everybody else by the RBI's lack of rate action, its decision to maintain status quo? Or did you think there was a faint chance that something like this could possibly happen? Let me start with you, Mr. Gandhi.
Yes, generally it was a kind of surprise, but I could guess it, because given the inflation trending up, especially the food inflation trending up, I had a kind of inkling that RBI may not cut it. So, but I was giving a chance of 10 or 15% only for that. Otherwise, I was also thinking that there would be a further rate cut. Anyway, so the final decision is to be cautious about the probability of inflation trending up. Hopefully, Governor definitely has mentioned that rate cut cycle is not completely through. So that means going forward in February, we can expect a rate cut.
Rupa, I know you were one of those who felt that monetary policy had reached almost the end of its limits and no further purpose would be served by further cuts. But even so, were you surprised by the fact that the RBI opted to surprise the markets like this? And also that the decision was unanimous. Even somebody like Ravindra Dholakia, who's always been a hawk, opted for status quo. Rupa?
No, not at all. I was pretty convinced that within the given inflation targeting framework, actually there wasn't much scope left for further rate easing. We have great experience of global financial crisis before us, and we had seen that monetary policy effectiveness is generally on the higher side in the initial phases of slowdown. But when the slowdown is very deep and protracted, unless we have a balanced policy mix also coming from the government authorities or fiscal authorities, monetary policy alone beyond a point cannot mend or repair the situation. So I think this decision was very well taken, and markets, I don't know why they were expecting 25 bips rate cut, because you see 135 bips has already happened, and even though there is a surplus liquidity in the system, out of 3 trillion surplus liquidity, 2.5 trillion every day is getting parked with Reserve Bank of India. So it's not getting converted into loanable funds for productive sectors. So issues are different. The perception of credit risk in the minds of lenders are there, and one has to work on that rather than just easing the rate cuts.
Yes, that's in fact what the governor himself said in the post-policy press statement conference. In fact, Mr. Gandhi, in his press conference after the statement, the governor said that, one should not go in for mechanistic kind of reductions every time, that you cannot expect a reduction in the policy rate, and that you need to give time for the earlier policy cuts to work their way through the system. That is entirely acceptable. But even so, the statement somehow gave a whole lot of reasons why inflation, even though it is rising, is likely to be a temporary phenomenon. Growth has fallen so sharply. So was there some kind of a disconnect between the commentary and the rate action, Mr. Gandhi?
Yes, there is conflicting information given through the policy statements. Yes, on the one hand, it talks about the inflation trending up, and other side you have confirmed information about the rate, growth rate slowing down. And because whenever there are conflicting data points and trends which are seen, typical central banking approach will be to take a pause, because unless it is clearly understood that which way the economy is moving, inflation is moving, and along with that the growth also parallelly, both are indicating very firm positions. Until that time, typical approach from the central bank will be to take a pause. Because here, having cut the rates in the past several policy meetings, Reserve Bank could afford to take a pause also. So it would have factored in that by making a pause at this point in time, we are not too much surprising the market, in case if that is what to be considered. So that's why they would have taken the calculated risk. Yes, it is okay to pause at this time, and also wait for the transmission to be taking further also. So I can understand post event, I can understand why they have come to that such a conclusion.
Okay, so better safe than sorry seems to have been the MPC and the RBI's policy, and the governor also described it as a pause. But Rupa, did you feel that given the kind of commentary that has accompanied the rate action, there was this disconnect that I was asking Mr. Gandhi also about? Or do you think it is not such a sharp disconnect and is merely that we as commentators and the markets were wanting to see a rate cut, and the rate cut was so much factored in that we are seeing a disconnect? So is there a disconnect to your mind between the commentary, which clearly seems to say that yes, even though inflation is trending up, it is going to come down, it is only a transient phenomenon, and growth has fallen very dramatically? So did you also see a disconnect?
Not actually. I feel the commentary on inflation outlook in the policy statement is quite clear. They have said that, you know, certain food articles like vegetables and all, we always see this kind of seasonal disruption and, you know, spikes in vegetable prices or perishable prices during this season, which is a kind of transient shock. But then there are some food articles like milk, pulses, etc., where it could be sustained because they are seeing clear shortages. But then, you know, what matters is, to capture the demand sentiment in the country is core inflation. And core inflation has been easing at a faster pace. You know, it has nearly collapsed. But then there also some supply shocks are seen, like telecos raising tariffs, etc. Sometimes we have this upward adjustment in health services and all. So everything is not entirely demand driven. But they know that growth weaknesses are lingering, demand pull inflation component is coming down, and these are supply shocks. Well, some of them are transient, and for some others we need to wait and watch. So they have taken this pause. I think that is perfectly logical.
Okay, so both our experts see logic in the RBI's decision to pause, or rather the MP's decision to pause. But Mr. Gandhi, you know, one of the biggest criticisms of the inflation targeting regime is that in the Indian context, the MPC has tended to interpret it as an inflexible inflation target rather than a flexible inflation target as it was meant to be. And does the RBI's and the MPC's action in the latest policy give further legs to the argument that we've always tended in India to look at it as a very inflexible target? Because even though the inflation estimate has been raised for the second half of this year, it's just between 5.1 and 4.7, and by the first half of next year it comes down to less than 4%. So are we again giving credence to this argument that the MPC in India has not made use of the flexibility that has been given to it under the Act? Mr. Gandhi?
I don't think that we can reach to that kind of conclusion so quickly. After all, Monetary Policy Committee, it is in operation for about 2 years plus now. So, in my opinion, it is too early to come to the position whether the MPC has firmed up in its own mind a fixed target of inflation. Because first, MPC has to see that the inflation behaves within the narrow corridor that has been prescribed under the statute. So, for that reason, even though they have not openly mentioned what exactly is the narrow flexible rate, because earlier Dr. Rajan used to mention that anything between 4 and 6, 4 and 6 is a flexible one. I think it is not necessarily true that they have made up a particular point around 4 or whatever. Today the situation is that a part of the inflation is trending up, especially the food, whereas the core inflation has kind of stabilized. But the household expectation on inflation, that survey indicates that again the household has started expecting the inflation to trend up, And this side, if you would see, the capacity utilization has come below 70%. So there are conflicting positions as of now. That is why they would have definitely, because when the growth is faltering again and again, counter-cyclical measures will have to come from the government. So they obviously, everyone is expecting, including Reserve Bank, I think that they would expect a policy announcement to come along with the budget coming in the early new year. So once that is clear, it will be possible for the bank to do some more rate cuts. That's the expectation. So the short answer to your point is that it is not that there is a fixed rate. Flexible rate, they are definitely following. Obviously, because nobody has given any number, it is left to either party to think that they have a fixed or a flexible one.
Okay, Rupa, Mr. Gandhi is being quite kind to the MPC and maybe with justification. But would it be fair to say that when the economy has caught the chills, the MPC seems to have got the jitters? Otherwise, why else would they want to retain status quo? Because after all, even a small cut would have buoyed up sentiment. I agree with you that monetary policy was perhaps reached the end of its limits, but it would have made some difference to sentiment. So can we say that the Monetary Policy Committee is always looking at it as an inflexible target, and what we really need, not just in the present context, but generally speaking, is a somewhat more flexible way of looking at inflation targeting? Rupa?
No, I am very happy you have raised this question, because it's very, very relevant at this juncture. And personally, I feel that sooner than later, they will have to consider that flexible inflation targeting more seriously than focus on a fixed inflation target. But as I said earlier, in terms of efficacy of monetary policy, there wasn't any scope for further rate cutting at this juncture. So actually, I feel by taking a pause but retaining the stance at accommodative, they have given a perfect signal to markets that they are in a wait and watch situation. Because you see, the way inflation growth dynamics is evolving, I am a bit worried whether we are moving towards stagflation. Because historically also, Indian economy is vulnerable to supply shocks, whether originating from food sector or fuel sector. And as Mr. Gandhi very rightly pointed out, household inflationary expectations have also started rising, not just 3 months ahead, but 1 year ahead also. Because household inflationary expectations are very, very sensitive to movement in food prices and fuel prices. So RBI has to give those signals very clearly. And I think another thing which nobody has mentioned, neither the policy document nor their press interaction, I think, but that concern must be there in their mind, and that is my guess, is faltering savings rate. You see, because fixed income earners and all, really the way deposit rates are moving downwards, you see there is a concern that if food price inflation picks up and if interest rates come down, again we will go back to 2013, 2014 situation when household sector savings had fallen very significantly.
Sure. So many a slip between the cup and the lip when it comes to kind of fighting, rising inflation, falling growth. But I'm afraid it's time for us to step into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with two experts on trying to understand the Reserve Bank of India's monetary policy announced by the governor on Thursday last week. Mr. Gandhi, Rupa also found some merit in the MPC's action. It's time to say that it's wait and watch. But frankly, the governor also said that it's important that monetary policy and fiscal policy should work in a coordinated fashion. And the statement says that there will be space for monetary policy cut, but further down the line. So given the statement that there is space for a further cut, and given a statement that there need for coordinated action, wouldn't this have been the best time for the Monetary Policy Committee to have opted for a rate cut, precisely because this is the time when willy-nilly we are going to see some fiscal loosening also, instead of which what we have seen is monetary policy and fiscal policy acting at maybe at cross purposes. When monetary policy was easing, fiscal policy tended to be tight, and now when fiscal policy clearly has no option but to ease, monetary policy is become relatively tighter. So is there some contradiction there again, Mr. Gandhi?
I don't think we have to see it as a contradiction, because it is, if had Reserve Bank increase the rate now, then we can clearly see it as a conflict. But as of now, it has taken a pause. That pause also has been guided by the trends that has been seen in the food inflation. Because as Rupa did mention just now, that a danger of stagflation, when inflation is rising, growth rate is falling down, we should not, the economy should not be going towards stagflation. So for that to be arrested, the Reserve Bank wanted to kind of keep its arsenal ready. So by cutting the rates further down, as again Rupa did make a definite point about the possible impact on household savings, because household savings have been trending down mildly, and if for fixed income group, if very reasonable returns are not forthcoming, then it can further disturb that balance. So considering that only, looks like all of them had decided unanimously, let us wait for February. By the time more clear indications will come about the inflation, because the supply side measures which the government has taken in terms of import of onions or all that, how far it will be, it is hoped that that will arrest the food price increases. Then policy announcement in the budget will also give a clear indication. Then it will be possible to even cut the rates even by 50 basis point, because this time around that 25 BP which otherwise everyone was factored in could be added to the possible next action. So it could be a sizable impact at that time. Possibly they had considered that also in the end, because they have that option of making a big impact in February.
Okay. In fact, the governor did mention that, because Rupa, he did say that in the case of monetary policy, timing is very important, and the next rate cut will come when perhaps its impact is going to be the maximum. But the fact is, monetary policy is a very broad brush instrument, and it's not a very precise instrument either. So is the MPC being very brave in assuming that it can time its rate action so perfectly as to have a maximum impact? Because as we've seen in the past, the MPC has often got it completely wrong. And in all fairness, monetary policy is much less precise as compared to fiscal policy. So is this a little brave on the part of the MPC that they can time the next rate cut very exactly to spur the economy, Rupa?
See, it is always an art in macroeconomics. Nobody can precisely guess how inflation and growth trajectory would pan out. But I think you look at the situation at the ground level. They have created so much of surplus liquidity, but as I told you, most of it is getting parked again with Reserve Bank of India, because lenders are not seeing viable options to lend. Lot of sectors today are suffering from slowdown. Entities, even AAA rated entities have for them the transmission has happened only on long-term loans between 45 to 50 bips against the policy easing of 135 bips. Some of the borrowers, for them actually the weighted cost of funds has gone up rather than coming down, and that is natural, because that is how the perception of credit risk in the minds of lenders would work, and they would add to borrower spread. So at this time, rate cutting wouldn't have achieved anything. Rather, the steps which have been taken by fiscal authorities so far, they would like to see that how that would revive different sectors of the economy. Now, fiscal authorities have also realized that, like you said, that monetary policy is a blunt instrument. Even some of the fiscal measures taken so far were broad brush, like reduction in corporate tax rates, because when demand slowdown is there and entrepreneurs don't have incentive to invest, they are not sure about the market, how they will increase the investment spending. So government has realized that they have to look at different sectors level. What is going wrong in telecoms, what is going wrong in renewables, what is going wrong in automobiles, what is going wrong in fast moving consumer goods sector, and accordingly take sector specific corrective measures. And as Mr. Gandhi said, the possibility of that happening is definitely around the budget time. So they will wait until then. Also, luckily this year we had very good water reservoir levels. Even if sowing of Rabi is delayed, it is catching up quite fast. You know, we have started seeing some early fragile signs of recovery coming from rural belts. And if all that and better Rabi crop, if it brings down food inflation, you see they will have better scope.
Yes.
Yeah.
Sure. Rupa, let me just interrupt you, Rupa, because we're running out of time and I need to move to some other areas also. Mr. Gandhi, let me just move to the related area of forex inflows, which the statement does talk about. They said we've had very strong forex inflows between April and November. It says we've had almost $9 billion of forex inflows as compared to an outflow of about 15 billion. Now, this is bound to add to liquidity if we do not want the rupee to appreciate. So, could that have been a consideration in the MPC's thinking? Because as it is, there is surplus liquidity. If forex inflows continue, we'll see further liquidity coming in. And though the governor denied this when he was questioned in the press conference, would this not have been a factor, Mr. Gandhi?
Normally, monetary policy committee does not look at the exchange rate implications, because that's a separate, completely, that is not within their ambit. Most of the time, as I know it, they won't be taking into account that. But your question is actually counterintuitive, in the sense that had they cut the interest rate, that would have reduced the attraction for foreign funds to be coming in. If at all, if they had kept that in mind, then they should have cut the rate. By keeping the rate at a pass, the foreign flow, if at all, will be continuing only. So I don't think that argument as I said, that exchange rate related consideration typically the MPC would not have while deciding about the rates. They will be more concerned about the inflation movements and jointly along with the prospects of growth. These will be their primary considerations, not exchange rate.
Rupa, let me turn to a related issue which is also there in the monetary policy statement and which really spooked the markets. The sharp downward revision in GDP estimates from 7.4% in the first policy statement to just 5% in the latest policy statement, clearly showing that it's going to be very difficult for the MPC to formulate policy when GDP estimates are changing so rapidly and so dramatically. So does this mean there is a case for the Reserve Bank of India to have its own GDP estimates based on high frequency data and accordingly for the MPC to formulate monetary policy? Rupa?
Yeah, I agree with you, because bringing it down in just a year, in a year's time from 7.4% to 5% is a huge downward revision, and I think RBI, that's why in consultation with professional forecasters and other independent groups, is definitely looking at that very seriously. But we also have a lot of problems in our macroeconomic measurement, because there is a huge disconnect between the story given to us by high frequency indicators and what we see in GDP statistics. There are lags, etc. So I think this requires effort not just from Reserve Bank of India but also from the statistical bodies in the country.
Okay, certainly I think that is something that we need to work on. In fact, Mr. Gandhi, the former governor, RBI Governor Dr. Subbarao, had said one of the reasons why monetary policy continued to be so loose after the initial stimulus period to post-2008 was precisely because GDP estimates were giving such a wrong picture. So can the RBI formulate its own estimates based on high frequency indicators, and would that be acceptable to government and then frame monetary policy accordingly, Mr. Gandhi?
No, that is not correct, because RBI's primary mandate is about inflation. So inflation forecasting, inflation model, it has to pay its full attention to. Whereas growth forecast is the mandate within the government and within the statistical organization of the government. So there RBI would, if at all, will have a kind of add-on modeling rather than the deep and totally independent modeling. If that is needed, it will require quite a lot of data generation with much beyond RBI's normal purview, because growth related data collection is typically through governmental organization, and very many departments down from the bottommost level. So but there to have a totally independent model, that won't be advisable. That won't be advisable in my opinion.
Okay, it would be difficult for the RBI, I accept. But let me now, Rupa, move to an area that you're very familiar with now, NBFCs. There has been a demand that RBI should do something to set right the NBFC sector, because only then will credit start flowing again. So very briefly, since we're running out of time, what should the RBI do as far as the NBFC sector is concerned, Rupa?
I think a lot can be learned from international, global central banks, and what was their response to non-banking sectors post the breakout of global financial crisis. So I feel this whole idea of creation of stressed asset funds for NBFC sector will go a long way in releasing capital for some of the NBFCs, which are today suffering because of illiquidity rather than any solvency related issues.
Okay, so the problem is liquidity, not so much solvency. Mr. Gandhi, I'll give you the last word, and that in the banking sector, because the RBI's June 7th circular clearly says that if the banks are not able to come up, with a review within 30 days of default, resolution plan implemented in 180 days, then they have to start making higher provisions and then refer to NCLT, etc. Given the kind of slowdown that we're seeing, is there a case for giving some kind of deferment for banks? Because clearly the problem lies beyond interest rates alone. We need to get credit flowing, and banks are not going to be able to lend if they have to make higher and higher provisions. So though this was not mentioned in the policy, would there be a case for RBI to relook at its earlier guideline?
See, prudential guidelines to be deferred or reduced, that won't be the right method of giving support to continuous flow of credit when the situation is downturn. That's not the method, because by letting banks extend the provision over a longer period or deferring the period, what is that we are actually achieving? We shore up the profitability of the bank in that particular quarter or in that particular set of quarters. That is, if at all, that will be welcome for the market people, but it doesn't add to the strength of the balance sheet of the banking institution. So that is not the real method. Support will have to come from somewhere else, not through provisioning requirements, changes.
Okay, so that's the verdict from Mr. Gandhi, that the support will have to come from something else, not continued forbearance. But I'm afraid we've run out of time completely, so we have to close this episode now. Thank you so much, Mr. Gandhi and Rupa, for joining me in the discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.